Before we begin, I would like to underline that certain statements made on the conference call today may be forward-looking in nature, and a disclaimer to this effect has been included in the investor presentation shared with you earlier and also available on Stock Exchange website. I would now like to request Mr. Singhal to share his perspectives with you. Thank you, and over to you, sir.
Yes, so thank you, Nishit. Welcome everybody, and thank you for the participation in the call today. I wish you all a very happy 2022. I hope we overcome challenges in the receding, and we are grateful to our frontline workers for their efforts in this pandemic. I'm also pleased to inform that PI has achieved an all-time high revenue and EBITDA in this quarter, with the revenue coming at 17%, while EBITDA going at 8% and PAT rose by 14%. This expansion came in despite of a high base of last year, that both the domestic and exports are rising trends of input costs. The domestic grew was by 8%, while the exports were a robust of 19% in the quarter under review. We are standing in the front line, frontier the leading edge technologies of complex chemistry. Our team are engaged in discovering better and more efficient pathways to commercialize molecules for a global arena. Innovators across the world acknowledge this, and we have a number of inquiries from existing and potential clients and partners and our rising market lead. Transactions in new inquiries has continued, and significant number of inquiries are coming from non-Agchem space too. Hence, giving the opportunity to build its next core competencies and in that area. We have acquired more than 8 new customers during the 9 months, and there's a rich pipeline of more than 40 products, which are at different stages being evaluated. And more interestingly, more than 20% of these are non-Agchem. We are targeted to commercialize 3 new molecules in Q4, in addition to 4 molecules already commercialized by December, a total of 8 for the year. We have commissioned new complex building block with a composition of flow and batch process of monomethyl hydrazine MMH. This is an extremely complex chemistry and challenging with technology transfers and capabilities, and we're scaling up production, and our team is one of the few in the world who have been able to build this production capability and demonstrate commercial production. Another great achievement that we are proud of. A domestic performance for the quarter was driven favorably by the agroclimatic Rabi conditions, supported by price hikes affected by key products. We undertook successful launches of one of our new insecticides for rice and 2 specialty fungicides focused on horticulture and rice. We've also successfully launched a number of new brands in the horticulture segment with the Jivagro, which continues to enjoy a strong sailing, which with our key product positioning well as category leaders. Moreover, over the 15 to 18 products at different stages of development and are going to get into registration. The idea is to further strengthen our market lines in the coming period, and some of our recent novel introduction continue to perform ahead of our expectations. Let me take you a few of the examples in that. I'm happy to report that Akira, the new wheat herbicide, continues to grow from strength to strength, and the treated acreage is increased 3-fold in this year. In fact, with Akira, we're changing the habits of the farmer. Again, a strong concept selling being done for the first time ever in that segment as a pre-emergent herbicide usage. The other interesting is the launch of pheromone-based product, PB Not, for the menace of the pest of pink bollworm, is another sustainable solution, and we're working with public-private partnerships to answer the covering needs of this and have been able to demonstrate this performance, which has given excellent results over 5 different states in the country. Once again, our foray into specialty biological product, first of its kind, which has now been launched into India in the grape segment. It has given a great innovative product to the market in the grape segment, which is safe and prevents disease management for, again, one of the challenging pests, which is the powdery mildew disease, and enhances the quality, also enhances the quality and the luster and the shine of the product. So another great 3 launches, which PI has brought some new innovative concepts into the ag market, which we expect over time to further scale up and to demonstrate our capability as a differentiated player in the ag segment. We continue to strengthen our marketing approach, Supporting has already a strong pipeline of brands working close quarters, especially dedicated personnel and pharma to enhance through better use of technology and modern best practices. Our business outlook remains robust and we are very confident of achieving the original growth guidance for the current financials. I would also highlight that we have refreshed the PI compass. We set ourselves a clear direction and a mission to further our growth. We set the purpose of reimagining a healthier planet, and our vision to lead with science and technology and human ingenuity to address the latent nutrition and health needs of the planet. We are aligning the organization across various levels in order to achieve and drive the PI compass. Our diversification into adjacencies through inorganic routes, our top agenda. Apart from technologies scale-ups, we are evaluating various M&A opportunities, both India and globally, to zero down on a few which meet the objective of creating a sustainable difference in value proposition in alignment to our purpose, vision, and the values by which we want to run the organization. We have elevated our homegrown talent and leadership in alignment to meet the delivery and development agenda aligned in terms of our purpose and vision, both in the CS and the domestic business. This rewards long-term business contributions, also helps to drive the culture of mediocrity and across all levels. Last but not the least, we are proud of our industry and customer accolades. As announced earlier, PI emerged in the top quartile company in the very first S&P Global Sustainability Assessment with an 82 percentile industry ranking. This ranking, with a gold star rating, with the 96 percentile rating of EcoVadis, a high score under the Independent Together for Sustainability, the TFS assessment for global customer, clearly demonstrates and depicts our ESG focus. The budget speech of our Honorable Finance Minister on 1st of February unleashed a series of programs for benefit of agriculture and chemical export sector. We believe these long-term policy initiatives by the government of India shall further boost opportunities in the Indian agriculture. Agri-input, especially chemical manufacturing in India, will help companies like PR in the further growth momentum as we move. With that, let me first thank all our stakeholders for their contributions for this quarter and wish you good health and stay safe. I, with this, would like to now hand over to our CFO, Manikantan, to share his highlights of our financial performance. And once again, thank you all for coming to participate on this call.
Thank you, Mr. Singhal. Good afternoon, everyone, and thank you for joining us on the call today. I'll be summarizing the financial highlights of the company for the third quarter ended 31st December 2021. Please note that all comparisons are on a year-on-year basis and refer to consolidated performance. During Q3FY22, we reported all-time revenues of 1356 crores, a growth of 17% over the same period last year. This was driven by solid growth in export revenues by 19% to rupees 1076 crores and 8% gain in domestic revenues to rupees 280 crores. I would like to highlight here that we have grown on a high base of last year, where domestic revenues grew by 26% and export revenues increased by 40% in Q3FY21 over the previous period year on year. The trend of elevated input costs continued during the quarter, although they have affected partial pass-through by increasing product prices both in exports as well as in domestic markets. Full impact of price hikes will be reflected in the coming quarters. Our gross margin contracted by 49 basis points in Q3FY22 to 46% due to lower export incentive and partial cost pass-through among others, which negated the impact of favorable product mix. EBITDA increased by 8% to record 297 crores. The margin moderation came in due to increased overheads by 24%, mainly attributed to sharp increase in fuel and other related utilities costs logistics costs, and one-off expenses pertaining to strategic initiatives. These one-off expenses are non-recurring in nature, and we expect our price hike to partially mitigate the cost increase in the coming quarters. Profit after tax improved by 14% to 223 crore, in line with our planned effective tax rate. Our balance sheet further strengthened during the quarter. Net sales to fixed assets ratio improved to 2.07 from 1.89 in March 2021, while total capex for YTM FY22 period stood at rupees 228 crores. Inventory levels were maintained at the similar levels of the last quarter to avoid supply chain disruption and meet customer supply schedules and continued operations. Company maintained its strong liquidity position with surplus cash and net of rupees 2,078 crore, including VIP proceeds. That concludes my opening remarks. I will now request the moderator to open the forum for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we would also request you to please limit your questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up question. Anyone who has a question may enter star and 1. We'll take our first question from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. First question on the CSM side. Decent growth given the high base as well on a year-on-year basis. But please correct me if I'm wrong. Probably this will be the highest new product launch for us in this financial year. Considering the new client adds which you highlighted as well, your thoughts on the incremental growth, maybe from a medium-term perspective, how should we look at that number?
Yes, so thanks. I think when we start looking at the business, since we're already in a high base, and looking at the growth, what is the good part is we've seen a lot of positivity coming in terms of the demand cycle in this area. And as you can see, we've grown this. In the coming year, very clearly, we will be further looking to enhance our capacities in terms of both bringing about by adding capacity in the existing facilities and also going ahead to probably start building the base for another MPP. We see a positive trajectory in terms of demand, both in terms of the existing business, in terms of new businesses which are coming. So PI's approach of always investing ahead of time is something that is probably going to drive our investments going to the next year, which should give a good trajectory going into the future. As you would appreciate that PI is always focusing on new generation products, and we are seeing some of the new AIs getting concluded in the demand cycle in our commercialization initial phase, which obviously will ramp up with time to come.
Sure. And just to follow up there, these new product launches, both for, let's say, YTD FY22 as well as what we saw in FY21, what should be the ideal time frame for us to see a scale up there? As in, these will be contributing significantly to FY23 revenues or 24?
Well, as you know, the new products will take usually 3 to 5 years before they touch maturity. And some of them are interestingly also in the area of the electronic chemicals as we diversify our activities into different fine chemical areas. So the maturity of these would be probably longer than 5 years, but yes, you would see a good substantial volume in 3 to 5 years. Yeah.
Sure. And a second question on the working capital side. I take your point in terms of higher working capital because of the inventory side. But even the receivables saw slight uptick there. Should we read too much into it, or because the receivables days have been steady at around 70 odd days since last couple of quarters?
Right.
What could be a new a number there to watch out for?
I think that's a pretty steady number to watch, but if I was to look at the area, it's an improvement over last year, as you would see. But obviously, inventory cycles are high, and that also goes to say, which creates our objective between customer satisfaction. We've been able to deliver more than 98% of our demands to our customers on time, even with the challenges of COVID over the last 2 years and with supply chain disruptions. So the inventory management optimization is done in a way to make sure that we can continue to smoothly supply product to our customer while augmenting our capacities. Yeah. And looking at this challenge, could last another year. This could be a challenging play, but internally the company is also looking to say this is going to be a new normal, so how do we optimize here further? That's the approach the organization is taking.
Sure. My question was more specifically on the receivable side. We were at around 80-85 days earlier, and we have seen that number coming down to around 60 to 70. But in the 9 months, we are going back to that 70 plus days on the receivable side. So is that the new normal that we should consider?
Yeah, I just wanted to clarify. Last year, DSO was around 16 and odd days and 31st of December 20. Right now, we are on 71 days. This is where we are, currently, as explained. And going forward, obviously, these things slightly fluctuate, but it will be in the same level of 69 to 70 days it will be.
Okay, fair enough. Thank you and all the best. Thank you.
The other factor there, if you are seeing this unfold on a blended basis, is some change in the business composition. So, because the blended revenue is export and domestic, and as you know that the receivable cycle in export is shorter than the domestic. Now, since the share of exports is more in the current year vis-a-vis last year, you see this change.
Sure. Makes sense, Mr. Sharma. Yeah. Thanks a lot for that. Thank you.
Thank you. We'll take a next question from the line of Bhavesh Jain from Kotak Investments. Please go ahead.
Yeah, thank you for giving this opportunity. So first question on this agrochem CSM, how do we see the growth over medium to long term, considering few of our Q molecules are going off patent over the next 2 to 3 years?
So, obviously there has been a certain challenge in the regulatory area for getting new registrations. As you would see, we will be launching 4 new products coming in the coming year. Are you talking about CSM? We're talking about AgChem, sorry, domestic.
I'm talking about export CSM.
Okay. So, see, generic or no generic, as you see, the contract manufacturing business is always working on the area of cost-benefit arbitrage. So there is no pressure on the manufacturing cost which could be driven from there. On the other hand, as genericization happens, and you would have seen that for any molecule, the key molecule inventor continues to hold a premium market share and price and continue to grow the market share. So as you would see, we see this not as a pressure at least in the next 3 to 4, 5 years because of these molecules, because the genericization cycle in some of the geographies in time and some of the geographies which are coming also offer data protection, which further continues to do that. On the other hand, our own ability with experience in terms of cost efficiency and 10, 15 years of these molecule experience in manufacturing, I'm pretty confident that we are the best cost structures in the world in some of these products as we continue to go ahead.
Okay. And the second question on this pharma CSM piece, post-INSWIFT, are we actively looking for more opportunity? And whether we can build this business organically and scale up much faster, or inorganic will be an imperative to scale up this pharma CSM business much faster?
So definitely we are looking. There's no questions on that. I think now the hunger is what is bigger because we need to catch up with time. So we will be looking at this place in both organic and inorganic. On the other hand, I must mention that while we will continue to invest to look at the areas for inorganic opportunity, we have got a team in R&D with dedicated resources and building our R&D capabilities further in terms of infrastructure, which will be worked on certain identified products, which are the non-GMP space. And on the other hand, we should be also augmenting one of the existing assets to do the pharma intermediates in this coming year, so that we continue to do organic. But as you would appreciate, we want to do something substantial and pretty quick. Organic, the pace is the way it is, which is continuing, but the inorganic action is what we want to accelerate the process, and more so get closer to the opportunity that we're trying to achieve, what we're trying to do earlier, but in a faster pace without losing the time dimension, which is been lost. But so we're looking at opportunities in that line.
Okay, sir. I have more questions. I will come back in queue. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Good afternoon, sir, and thanks for your time. On the pharma inorganic acquisition, would there be an outer timeline by which we can expect you to close something like 2 quarters, 3 quarters? Is there something, an outer timeline that at least you can give us?
Vishnu, thank you for this question. I would like to do that as soon as possible. So we are looking, but we got to make sure that we get the right bite, right?
Sorry.
Obviously, I'd like to get some action moving, obviously, within the year. In next 3 quarters.
I'm sorry, sir. I'm not able to hear you clearly.
I said, we would like to move this as soon as possible as of yesterday. So obviously, we're looking on an aggressive pace, and we would like to have something moving in the next 2 quarters for sure.
Got it, sir. And so just wanted to some thoughts on you mentioned MMH, and you also mentioned about some non-agro products that you're looking into. Firstly, on MMH, wanted to understand what is the opportunity, what is the growth potential, if you could give us some insights on it. And secondly, on the non-agro products, when we are scaling up, would it require additional capex, or how should we look at the capex and growth trajectory on this side?
So, you see, MMH in any case is a backward integration strategy, and we're also looking at certain core intermediate blocks, which is further giving us the cost arbitrage and a risk mitigation plan, back with the opportunity to have certain revenues and skills in certain intermediate blocks. But the interesting fact is unique of its kind in terms of the way the molecule, the process technology has been worked. It's a combination of flow and batch, so it gives us a new capability enhancement of dealing with hazardous products and science. In regards to obviously the CapEx, as you know, we have put some aggressive capital over the last 2 years. And as you've seen, that we've also looked at 15 to 20% capacity enhancement through operational excellence and efficiency. The footprint of the MPP10 is far bigger, is 30% bigger than any of the other MPPs. So this revenue growth plan is going to be driven by that. But looking at what we see coming in, we are looking at 2-pronged investments, which will probably come to you post next quarter as a business budget and all gets approved. That we are looking to further get into putting up another MPP. And on the other hand, we're also looking to augment one of our assets and upgrade it to the pharma intermediate space so that we have the organic play which we are planning to do into operation by the end of the year.
Understood. This pharma, organically, what is it, the revenue potential that we could possibly reach by next year or maybe 1 or 2 years that we are currently working on?
So that would be too early for me to comment. We are at different stages of evaluation, right? So we are maturing and working on this. We will come back with a better understanding in the next couple of quarters.
Got it, sir. Thank you. And one suggestion, the voice is very it's not clear. Maybe I think you're speaking in the speaker. If you possibly change it, to be useful. Thank you.
Is it better now?
Somewhat, but better. But it could be much better.
Thank you. Our next question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. So we have mentioned that we have partially passed on the price increases. Now, given the cost pressures that currently we are facing, we will be passing it on in Q4 as well. But in case of retreating of the input prices, what generally happens, because there is a lag in terms of passing on the prices, input cost increases, but whenever the input cost again decrease, then how does it work for us? Thank you.
Well, it's the same cycle, no? It works one way or the other way. But typically, we have the inventories and time to which these orders are committed, so that's less of an impact than the input, so that kind of works up in the same way.
Right. So generally, it is about 3 months in terms of the lag effect that comes into play on either side?
It takes a quarter, depends on the product and offer, yes, quarter or so, depends, and also depends on the inventory levels, yes. Typically, that's the average time you can look at, yeah.
All right, sir. Thanks. So the second question is on the balance sheet. So we have borrowings of close to about 300 crores and we have a cash surplus of about 2,300 crores. So any specific reason to keep those borrowings on the books?
Money?
Yeah, thank you. It's on the ECB, which we have taken up a couple of years back. That is with an average maturity of 5 years. It's continuing in the books. It's beneficial comparing the rate at which we have taken at that time. So we also evaluated the same thing and find that it is still worth to keep the ECB on our books.
Right, sir. Got it. Thanks a lot and best of luck, sir.
Thank you. We'll take our next question from the line of Madana Gopal Ramu from Sundaram Alternates Limited. Please go ahead.
Good afternoon, sir, and congratulations for a very good show on the CSM business. Sir, you mentioned on the MMH capability coming in. If I understand, it is going to help us to become more cost competitive for scaling up the existing products, or is it improving our capability to, say, synthesize more new molecules?
It does both, to be honest.
Okay. So benefits of this are likely to come in the medium term, or do we have to wait really say 3-5 years?
This is not going to give us revenue of MMH. We're looking to get revenue for the products that we have in the pipe.
Yeah, that's what I'm asking. So it's in the molecules already commercialized. We'll see the benefits of this coming through.
Some of them and some to be. Okay.
Okay.
And apart from
you also mentioned about
apart from cost, this also de-risks the availability of material, on time, because so far this was being imported mainly from China. Okay, and as you know, given the current scenario, it is a strategic move to de-risk from that port.
Okay. And the second question I had was, you also mentioned about the flow chemistry getting commercialized. Can you elaborate a bit on what that would enable us in terms of scaling up the existing molecules?
I mean, flow chemistry, pardon?
You also mentioned about the flow chemistry getting commercialized this year. What kind of advantages that will throw us?
Yes, the flow chemistry is a capability development. The organization doing, which will look at the active structures in a different way. And we will be we're looking to commercialize one of these areas, and that will give us the confidence to look at a different way to get a return on assets with time.
So basically, this will help in two ways. One is that this will dramatically reduce the plant's footprint, which means that the capital efficiency, which is the key objective, long-term objective of ours in this business, that will be gradually achieved. And then apart from capital efficiency, even the cost of production improvement, cycle improvement, all those benefits, safety, these benefits also will be achieved.
Basically, it leads to enhancement of capacity in the existing facilities.
Capacity, cost efficiency, and also safety. All 3-4 objectives. Yes.
Okay. See, can you put on the capex for the current year and also what kind of capex budgeted for the next year, if you can guide us on that?
Well, we're not frozen the capex for next year, but money for this year, can you please?
Capex of 228 crores up till now, and we expect, as we spoke in the last quarter call, around 300 to 350 crores would be the capex for the year.
Okay, thank you so much.
And next year's capex plans are still in discussions in the making, because there are several sectors, including the pipeline, including some of the inorganic opportunities that we are evaluating. So, the finalization of next year's capex will only happen by end of this quarter or something.
Sure. Thank you.
Thank you. Our next question is from the line of Aditya Jawar from Investec Capital. Please go ahead.
Yeah, thanks for the opportunity. Congrats for reporting strong growth in CSM. The question on CapEx, got partly answered, but one thing just wanted to understand that organically for us, if we have to think about CapEx for 23-24, in the order of magnitude, could it be 20-30% higher or much higher than that? Any broad sense on CapEx for 23-24?
Yes, if you want to look at it that way, but at the same time, I want to highlight that we also work on technologies to improve asset utilization, as you've already seen this year. We have other plans to do that. Followed is we are putting some of the flow areas that will work. So that is why I think what Rajneesh mentioned earlier, we're still looking at the technologies and balancing between risk and rewards and putting up a CapEx plan. But clearly we see a positive trajectory in looking at the CapEx depending because we are seeing a trajectory in demand. And as you would appreciate, that over the last 2 years, we had aggressively put in CapEx because, typical our belief for building capacity before demand. So I think that's what's supporting us through this process, yeah?
Yeah, that's encouraging to hear. So, broadly, if we can get a sense that what is the line of sight of improvement in asset turns that we can expect in the next, 2 years by the, so many projects that we are doing, how much upside we can see from the asset turns from the next 2 years?
This is again a chicken and egg story, to be very honest right now, because one side, if we are getting inquiries for sometimes, in this business, you can't build an asset just for the revenue. We'll have to build a capacity based for a 3 to 4 year visibility, right?
Yeah.
So the investments sometimes go up front when you get those peaks and troughs, but obviously the objective is to improve its efficiency. But in the next 2 years, looking at what we see in terms of surge in demand, in terms of capacities we may build, I would see marginal improvement here, not something substantial to be really taken down, yeah?
Yeah.
We have seen some improvement in this year, in this quarter also, as you have seen. And we are confident that while yes, on both sides, on one side, commercialization of new projects happening, building of new capacity will also happen, and on the other side, we are also kind of implementing some of these technologies to improve the efficiency, plant efficiency throughput. So combined impact will come. Difficult to quantify that as of now, but the direction is very clear that capital efficiency is gradually going to improve.
Yeah. Okay. The final question, if we have to break the current capex, that is about for FY22, that is about 300-350 crore, into the maintenance capex, the capex for backward integration and growth capex. Roughly what could be the breakup?
Money, you would have that?
I will readily and I have to come back. Normally we don't give such breakup on the capex front.
Fair enough. Just one part that just if you can give what could be the capex for the backward integration, that would be sufficient.
Yeah, that is not significant because some part has already come earlier, some part has come within this quarter, so I think not more than 60-70 crore or something.
70 crores for FY22?
Yeah.
Okay, perfect. Thanks a lot, sir. All the best.
Thank you. Before we take our next question, we would like to request participants to please limit their questions to 2 per party. Our next question is from the line of Abhijit Akela from IIFL Securities. Please go ahead.
Yeah, good afternoon. Thank you so much for taking my questions. Just a couple of clarifications. One is, if it's possible to share the Isagro export revenues for this quarter and for the 9 months. That would be helpful. Thanks.
Yeah. Money, you would have that, or you will share what separately? Isagro.
Some export revenues we will share separately, please. Sure, I will revert.
Okay, thank you. The other thing was just to confirm that we've talked about this 20% kind of CSM growth target for the next few years with good visibility. So we are still on track for that. And on the domestic side, what kind of growth would we expect for next year? And also, if you could just comment on the margins, is it possible that we could see a recovery next year off the low base of this year?
Yes, as we projected, the growth rates are looking to be in the same direction. And obviously, as will also catch up the growth rate as we expected to do, far better than what we've had. Based on the launches of products and new products coming to registration, we see a good year going forward.
Thank you. One last thing. InSwift, sometime back in December, put out an announcement saying that apparently PI has approached the commercial court at Gurugram, for some kind of arbitration and conciliation. So if you could just, confirm whether that is the case and what is the update on that and what do we sort of, plan for that discussion going forward?
Yeah, Abhijit, since the matter is sub judice, I think it will not be correct on my part to kind of put any commentary around it. But yes, some proceedings are happening on that side.
So the idea is, that we're still sort of trying to see if, a deal can happen there. Is that the thought process behind that, or?
No, this is what I said, Vijay, that since the matter is still this and there are certain proceedings, legal initiatives taken by us, so I think it is not correct on our part to kind of put a lot of detail and commentary here on call.
Understood, sir. Yeah. Thank you so much. I'll come back.
Thank you. Our next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Two questions. One on talent management, retention, nurturing, and growth. What are the thoughts, strategies, and ideas? We have seen over a period of time kind of a recurrent separation of talent time to time.
Yes, so as you've seen by that we have just now put a whole strategy of develop and deliver agenda for putting a new purpose and vision strategy to put the whole talent map together. Clearly the organization, looking at the objectives it needs to achieve, it looks at talent and talent management approaches in line to that. We would have seen certain talent that was acquired in order to help and augment the organization to grow and move to the next level. While internally we have been able to develop the new talent, which has come in shape to the leadership of the two leaders today, having vast experience to drive the future strategies and growth. And as a constant drive, we have taken many initiatives in this area, and we are continuing to grow in-house talent in line with the competence and capabilities required for the future growth, which has been defined and described by our new operating business model.
Mike, your voice is not very clear. If you can speak closer to the mouthpiece or without the speakerphone, I think it will help. So are we kind of happy about our initiatives, or is it a source of concern given a fair number of departures that we have seen?
Well, I'm not sure that what level of departure that we're talking, because some have been retired, some have moved on because of a certain data. And we have enough talent in-house which has taken up charge and shape, which was developed, which is there. So if I still look at the data points, PI's attrition rates are far lower than the industry average, which is being faced in today's growth opportunity that the industry is operating, right? But at the same time, we are looking to always, today's world is a little different world of the youngsters. So the point is that we are working on a strategy where we have well mitigated risk from talent by developing talent internally. And most of these positions and growth rates have been taken internally, and we continue to invest in building talent and acquiring certain talent back in alignment to the strategies of business areas that we want to focus for our growth. Yeah?
Okay. My second question is going back into the past and projections for the future. So 4 years back, when we were discussing, we were saying that in 5 years' time, we should be $1 billion business, and capital efficiency to be in the 30s is return on capital employed. $1 billion 4 years back meant about 6,800 crore or thereabout. So are we on the way next year to be around that ambition, and on capital efficiency the objective of in the 30s rather than 20s? And corollary to that, if we have to thereafter think of our business, whether in 3 years, 4 years, or 5 years' time, we believe given initiatives, given client engagements, new chemistries, and our product offering basket, are we likely to see the business doubling? Whether 3 years thereafter, 4 years, 5 years, when?
So that question, we're not an organization that likes to be asleep. We want to grow at an aggressive pace. And clearly, yes, we want to deliver that. I'm pretty confident that given the energy, the drive of the team internally, and a passion to grow in the areas of our competencies, the areas of technology, more importantly, anchored with the ESG framework and sustainability. We don't see these kind of challenges, obviously, but both organic and inorganic to achieve the objective that we have set out for ourselves, and we will continue to do that. Obviously, if you look at what you did question of me today, if we didn't have one of the M&A activities, we would be well there in that number. But, we're looking for other opportunities. So what stops us from not getting to that number, which we set ourselves out to achieve, and what we are looking to do in the next 4 to 5 years, we would like to be more aggressive in order to get to the space faster. And that's what we're building, the organization resources. So we've already deployed a large number of resources in the areas of growth, opportunity, and identification.
The reason why I'm asking that question is opportunity probably has never been better for India in general, and more specifically for PI, given the kind of favorable position PI has put itself into with research-driven chemistry and foraying into allied branches, as well as client relationships and global affinity for India-based quality specialist players like PI compared to the other competition in other parts of the world. Therefore, time to get more ambitious probably has never been tomorrow. Probably it is yesterday, I would have thought.
Yes. Ambitions are never going to die, number one. Number two, as you rightly said, technology and ABC. So technology is not purely sometimes chasing the long tail with steps of differentiator. And when they get to that tail, it has to give you a spike. So as you see, PI is working in the discovery area, and this is a long tail. And so therefore, we're not giving up that, and nothing like the opportunity that India today has to offer. We are looking at the technology capability which is going to be more globalized rather than localized and opportunistic in nature. So we've not left our path, as you know, we've set our path and we're moving up the value curve. And as we mentioned, we're focused on the discovery area and we're talking to global partners on the development front, which puts PI into completely a different technical competence capability compared to any of its competitors in that scene. On the other hand, our chemistry capabilities, which have been leveraged across the other application areas, would also augment our strengths and also widen our offerings to a different basket of customers and yet create a larger differentiator anchored with some of these areas. So we are pretty clear and confident this would give us the next kick-up of growth. It takes the base foundation to become strong, and when you're developing technology, the kick-ups happen pretty well. And we're pretty confident that we're well on the way to do that.
Sure.
The Make in India initiative is, while positive, but our idea is to make in India for the world with a differentiator to say that there is the best of technology, the best of cost. So we're focusing on both the angles here. Not just the lever of cost today or the opportunity of the landscape being offered now.
Sure, thank you. I continue to be admirer and well-wisher of PI's journey so far. I hope that is the way it stays.
Thank you. Thank you for your wishes.
Thank you. We'd like to request participants to please limit your questions to 2 per participant. Time permitting, you may come back in the queue for follow-up questions. Our next question is from the line of Tejas Sheth from Nippon India. Please go ahead.
Hi, good afternoon. As we continue to pursue the pharma CSM space through inorganic route, what is the aspiration for us to have the revenue from the same over next 3 years organically? Hello?
Mr. Nayan?
Hello. We didn't get your question. Sorry, can you go back to that?
The question was on the pharma CSM. So obviously we are pursuing the inorganic route on the segment. What will be our aspiration to from that segment over next 3 years on the revenue side, organically?
Organically.
Well, right now with the bids of construction, but obviously within the 3 billions which we are ready looking to see. Because otherwise it's not going to be substantial enough for PI to chase.
So no, just a clarification on that. So even if we don't acquire any asset, are we looking at 1,000 crore of revenue potential over next 3 years?
That would be 1,000 crore in pharma, my friend, is a pretty large revenue which will not be possible organically to do very straight in 3 years. Yes, no chance. But obviously, 150 crores when you're looking at the area of intermediate non-GMP. So the organic route is where we're going to leverage to grow to that revenue in 3 years. You can't get that number in organic way. Sorry.
Okay. And on the agro CSM side, I mean, if you see 4 years ago, I mean, there were only 3-4 players which were very key to the innovators. But as we see today, there are many players, and most of the business now is done through RFQs rather than on relationship basis. Are you seeing intense competition on CSM agro side?
Well, I'm not sure about what you mean by RFQs in this because, it depends on where you are. Number one, yes, there are many more players. The landscape will expand as businesses expand and as the first movers. But again, which part of the pie? Because there are also outsourcing with moving from China to India, which could be also in the generic space, which could be for products which companies are already making, or intermediates which companies are making and are getting business opportunities which they were uncompetitive for cost in the past. So clearly, for new generation new product development, I am not seeing the RFQ approach really happening. It is still based on competencies, capabilities, and partnership of trusts which are taking that game. And they definitely have a role to play, and specifically where they see that they're looking for continuous improvement to deliver efficiency and cost. So obviously, competition is going to come and will come, but the point is, what are we doing and what we continue to do to create, be ahead of the competition? And that's where we have our capabilities in the area of technological build-ups for what we see in the new generation products to value offer to our customer. So that's where it is right now. Yeah.
Got it. Yeah. Thank you very much for answering.
Thank you. We take our next question from the line of Khushi Doshi from Axanoun Investment Management. Please go ahead.
Thank you for the opportunity. So FY21 annual report mentioned that 46 new molecules were synthesized during the year, out of which 20 were scaled up and 6 were transferred successfully to the next stage. And 5 molecules were commercialized during the year. So my question here is, what is the percent of molecules that are commercialized for the company from the total molecules synthesized? It would be better if you could provide last year's as well as 5 years average numbers. Thank you.
Well, to be honest, we don't have them with us right now, but typically it's a funnel. So the funnel of commercialization, because some have 3-year gestation, 2-year gestation, 5-year gestation periods, or some even have shorter gestation periods. But nothing gets commercialized from an inquiry to commercialization less than 2 years. There's a typical time frame for producing samples, approvals, pilotization, further approvals, regulatory work if that is applicable, and then putting up facilities or optimizing facilities for production.
Okay. Could the number be provided any time later?
Yeah, we can get somebody to put that to you.
Thank you. Also, could you shed some light on what type of electronic chemicals is the company working on?
Well, we can't put detail onto that. As you know, we are bound under very strict confidentiality clauses with our partners. Yes, you're working in that segment. And again, they're in the innovative area.
Okay, thank you.
Thank you. Our next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Can you talk about the Orchida performance in this quarter and what kind of target we have for this product for next 2 to 3 years?
The performance, I would say, as you highlighted, the performance of the product has been very highly satisfactory. Actually, we're very well overwhelmed with the kind of performance. More importantly, this has been done because the excellent execution and hard work of our team to have done a phenomenal fieldwork activity for concept selling, which has shown us a 3x jump over last year. And clearly, the way I see it, going into the future, it's competition sensitive, so we definitely are very gung-ho, as I would start out saying, aggressive growth plans on this product. Not only that, but we have a bunch of 2-3 new other molecules are coming in, which we would see a huge shift in the way we see demand in the domestic sector.
So do we have any target of some particular numbers we are going to reach in maybe a couple of years?
I would not like to highlight that for, as I said, for competitive intelligence purposes and also. Okay. But yes, as I said, we have pretty good aggressive growth numbers and we are confident that that can be done. Yeah.
Okay. And the product you have launched, a PV Knot, can you talk about the potential target overall? What kind of growth potential and in this product?
Prashant, maybe you can give some input on the PV Knot and how you see this as a social program. Maybe Prashant, are you there?
Hi, good afternoon. So PV Knot is a novel technology which we are basically widely testing at this point of time. And this year also it has gone through a lot of testing and trials, commercial trials. We are hopeful to commercialize this in the coming year in cotton area. This product is a pheromone-based technology and it is basically tied to the plant and it has to be a community approach which farmers have to adopt. So that is why we are also working with various communities, various FPOs and the government organizations in Maharashtra and Punjab as well. So because it's a novel insecticide, it is a new approach which we have to follow and the community approach. So it is going to take a little more time than the regular insecticides. But it is a good product and we are hopeful. At this point of time, there are no other products which can give this kind of control on PV Knot which this product can give. So because of the community approach which we need to follow, so it is going to take a little more time to scale up. But it is going to be a sustainable product and it is a long-term product. That is how I can put it.
And just one more thing I would add, the pink bollworm is a pretty menace in the cotton pest and there is no other solution. But this is again a unique concept selling where it needs a huge amount of public partnership and participation to make sure that the farmer is able to see the benefits. And I must say there's a huge interest which has been shown by various state governments and head governments to say that how Korea can partner to put this concept into the market. And I think the positive outcomes have been very encouraging, to the extent that we have been able to socially make an impact of this product and make sure the farmer is able to get a better crop yield and not get damaged by this pest called the pink bollworm.
Is it a licensing product?
Sorry, what did you ask?
Is it a licensing product?
No, it is our own registered product. Yes, obviously we partner with a Japanese company. But we have an exclusive license for India.
Okay. Thank you so much.
Thank you. Our next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for taking my question. So just on the, given the commentary on the flow chemistry side, what you have mentioned, there is cost efficiency, OPEX efficiency as well as CAPEX efficiency driven by that. So is it fair to believe that going ahead, whatever CAPEX that we will be planning, that would be largely based on that? If that is yes, then what technological challenges that you could face in developing or in developing the processes for the flow chemistry technology?
Ladies and gentlemen, we request you to please remain connected. It looks like Mr. Singhal's line is dropped out. We'll just reconnect him back. Please hold the line. The call will start shortly. Ladies and gentlemen, thank you for your patience. We have the line for management connected. Mr. Patra, we request you to please repeat your question.
Yeah, thank you. So just I was asking about the flow chemistry about which that you have commented that this is going to have both OPEX efficiency as well as CAPEX efficiency. So going ahead, is it fair to believe the larger chunk of our CAPEX will be driven by that? And if yes, what challenges that one would see in developing the processes to fit to the flow chemistry?
I'm not getting your voice very clearly. Sorry. We talked about flow chemistry, then the other part was muffled before.
Is this line is correct now, sir?
Maybe you can put a bit further away because the voice is cracking. So if you talk further away from your phone, maybe clear.
Okay. So I was asking that, sir, since we have talked that and that is known that this flow chemistry, if it is implemented right, then it can offer both CAPEX as well as OPEX efficiency meaningfully than the batch process. So if that is the case, then going ahead, large part of our CAPEX would be driven by that.
Well, let me put it this way. It is number one, it's a flow chemistry, the concept which has been around for a while, which is now getting into some people looking commercially. It is not that it can replace batch processes. It is not something that in all chemistry, in all kind of areas, this can replace. And yes, in certain critical areas, it can replace, where it can give both operational excellence and also can give you safety and a capital cost structure. So the PI is building this capability and looking at certain of the areas of opportunity that we have, where we can actually bring this value offer to the table for the company, right? And once we build this capability, maybe we can drive more project and strategy aligned to that, yeah?
My second question is on the kind of new areas that we have been talking about, sir, whether it is the fine chemical one or the pharma one or like that, or the electronic chemicals, what we have already initiated something. So, let's say on the 3-year time period horizon, what is the kind of revenue mix that we should be seeing out of non-agro base? And also, if you can add to that in terms of customer composition in the CSM side for the non-agro base, what is the composition it would look like 3 years down the line?
In the organic way, for 3 to 5 years, we could see about 15-20% of this. Because we're looking to continue to grow on that big base there, and also at the same time, it's based to cash, yeah?
Okay. Same is the case even the customer composition.
Yes.
Okay. So just if I can just add in here, like what is the current base of our agro CSM customer base, and what is the potential target customer base? Means whether we have enough scope to add more customers to our customer base, or something on that front also if you can add.
Well, there's always a scope, but I think we're covering most of the customer bases in that, where we are focusing on the products in the custom manufacturing point and looking at the pipeline, working along with them, yeah?
Sure. Thank you, sir.
Thank you. Before we take our next question, we request participants to please limit your questions to one per party. Our next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi, sir. Good afternoon. Sir, slightly in line with the previous question only, sir, we have been leading player in agrochemical CSM and among the probably first player to enter into that business and have done extremely well. But somehow, sir, probably we have not been able to scale up our capabilities in other segments in non-agro, whether it's a pharma or probably in newer segment. So do you think that there are limitations that from agrochemical players, it's challenging to get into other businesses while other chemical players probably who are non-agrochemical focus are probably able to scale up their capabilities in other segments? Is it a limiting factor, sir?
Well, I don't think so that at all. I think we focused on something and achieved height, and that very clearly, as we're saying, we're now focusing on the other segments and going at it. And pharma is very clearly defined strategy. Okay, in the short term, we've had this challenge of this M&A opportunity, but I don't see that as a challenge. It is more about getting it done, and that's where we are. And we see the opportunity in the other areas, which is already entered. Obviously, we would have seen that the CSM business that we have been able to achieve has not happened overnight. It's taken 25 years, 20 to 25 years to get to where we are today, right? So it takes time, and if you want to focus strategically in the right space, and some of these we've initiated long ago. I mean, if you today talk the non-electronic chemicals, we're talking about for now 3 to 5